Now you might be asking the question, why use superannuation to save for your retirement? The important thing here is that it's an effective structure in which to save for your retirement. If you look at all the structures, you can invest in your individual names, you can invest in joint names, you can invest in a trust, a company, or in superannuation. And superannuation, as we've mentioned this session, is broken into the accumulation phase and to the pension phase. And there's different tax rates. This chart is trying to illustrate the different tax rates based on all those different structures. Now, there are other structures. There are insurance bonds, investment bonds, education, scholarship funds, first home savers accounts. Actually, they've closed now to new people. And there are annuities as well. But the structures here that we've got in the table are the main structures. So individual, joint, trust, company, superannuation. Now, to cut a long story short, the benefit of using superannuation to save for your retirement is that in the accumulation phase, the tax payable on the earnings is 15%. Or on capital gains, if you're selling an asset within your super, it's only at 10%. But the key thing is, for those people that are reached their preservation age, when in the pension phase of super, the earnings on the fund are not taxed at all. There's no capital gains payable, whether they're short-term gains at less than 12 months or more than 12 months. There's no tax payable. And this is the key thing to take home from this. If you're investing in your own name, then you'll pay tax at a lot higher rate than 15%. If you've got an income higher than $18,200, then you'll be paying tax. If you're earning over $18,200, you'll be paying tax at least at 19%, but potentially higher. So when you compare that to a 15 or 0% tax rate, you can see why having money in the superannuation, particularly the pension phase of superannuation, is of great benefit to you. But if you determined or you appreciate that superannuation is just a structure, it's an effective tax structure, then you might be thinking, well, how do I get money into the superannuation environment? And this is just looking at an example. If you've got employment income of $90,000, your marginal tax rate this financial year is going to be 39%. So if you chose to invest in your own name, generated 10% or $10,000 return, then that's the tax payable on that would be $3,900, and your after-tax return would be $6,100. Whereas if you were able to put that in the pension phase of superannuation, your net return wouldn't be $6,100. It would be the full $10,000. You'd get that full return of $10,000. So this is comparing investing in your individual name versus investing into your superannuation. That's the benefit. So you'd be netting nearly another $4,000 here investing in superannuation in the pension phase of super than you would be investing in your own name. So if you figure that superannuation is a great environment in which to invest, then the question is, well, how do I get money into the super fund?